now, Partners Group Chief Investment Strategist, Anastasia Amoroso. Anastasia, what does it say when even fireworks from a company like NVIDIA start to look like warning flares to investors?
Sure, Liz. Good to see you. I think it says a lot about positioning. Going to NVIDIA earnings, I think positioning was certainly stretched in terms of longs on NVIDIA. It seems like it was really short software. And it's interesting, if you looked at the same stocks last night, you would have seen NVIDIA trade up. You would have seen CRM, Salesforce trade down. And I think a lot of the reversals has to do today with some technical forces. But I do want to just defend more broadly the AI trade. And, you know, what NVIDIA really said is that the demand for compute is essentially expanding exponentially. It is insatiable. And I really also liked kind of the new growth engine that Jensen Huang has referenced, which is this adoption of agentic AI. That's new. We've been in the era of sort of conversational AI, consumer AI. We're now moving into the era of enterprise AI being embedded in more and more software applications. So I see a lot of positives actually coming out of that NVIDIA report, and even Salesforce as well, talking about the adoption of agentic AI in their business.
I mean, look at software stocks. They've been absolutely crushed over, I want to say, the last couple of months on all of this AI disruption fear. After the bell, we are getting a bunch of names, and they're tech names, and some of them are really crucial software names. I'm thinking about Autodesk, Zscaler. And if you look at, say, for example, Zscaler, down 27% year to date, Autodesk down 22% year to date. You're saying, please do not over panic on these stocks, and wait till you hear what Jensen also says about it.
Yeah, absolutely. I think investors need to take a near-term kind of stance on software versus a longer-term stance on software and pockets within software. The near-term stance is that I looked at the numbers of companies that have reported, and we're getting close to 80% of those reported, and they're delivering earnings growth of about 20 or 30%, and pretty decent earnings beats as well. So, you know, so far, there's certainly no death of software, and certainly not in earnings. Longer term, Liz, I would say there are definitely going to be pockets of legacy application software, which we do have quite a bit of in public markets, that likely will have a slower growth trajectory. And that's what investors are pre-positioning for.
A little bit of a shakeout there. But if you look at the AI trade, we've had so many people sitting in that chair and saying, oh, go with the nuclear names, go with the energy names, because they are there. Go with the picks and shovels and the blue jeans of what could be the AI trade. You talk a lot about the industrial picture and how important it is.
Right. I mean, it's been hugely important, I would say, and played out in the market so far this year. If you look at energy, if you look at, the industrial names, the defense companies, they've actually outperformed just about everything else this year. And that's right, Liz. If you look at CapEx numbers year to date, they've really inflected higher. And what's driving this CapEx is starting to look a little different. You know, in the last 10 years, it's all been about software CapEx and spending on software that was going to eat the world. And here we are today, and the ratio of hardware spending to software spending is getting close to 50%. So there's this heavy asset reallocation that's happening.
I want to give a little preview of what Jensen Huang specifically said about in essence, the fact that AI may be the first sort of technical revolution that isn't a blue-collar job killer. So let's take a look and listen to that.
Don't forget, AI is creating jobs all over the United States. All these AI factories and all the data centers, the chip plants, the computer plants, and the AI factories that need to be built, the number of trade skill labor jobs that we're creating around the United States is really quite extraordinary. I'm delighted to see it, and that's a whole segment of our economy and a whole segment of our society that we really would love to have built back in the United States so that we could become a re-industrialized country again.
Asset-heavy sectors.
That's right.
Machinery. Materials. Is that what you're talking about?
That's exactly right. And that is exactly what's visible in the numbers today as well. For example, if you look at employment in the construction industry, it is picking up. Some of that is due to data centers. Some of it is due to utility CapEx, which has certainly picked up as the share of sales in the industry. I do worry, Liz, about some of the white-collar job cohort that is being disrupted by AI as we speak. You know, 1% of the labor force today has 100% automation potential by artificial intelligence. A quarter of the labor force has a 90% plus automation potential. And if you listen to the Anthropic live event that happened earlier this year, this is the year of knowledge worker disruption, and that certainly does have implications for the labor market.
I don't want to ignore financials, because in some cases we've watched private equity names and private credit names really start to wobble a bit here. Part of it was the Blue Owl situation where the private credit leader, I mean, this was a real momentum trade over the past couple of years, started to give investors heartburn because they shut down the opportunity in one of their funds for investors to remove their money. And how do you see that playing out?
Sure. Look, we have to set the record straight a little bit on, part of the Blue Owl situation is the vehicle that ultimately was selling the loans was not the vehicle that was supposed to exist in perpetuity. It was a finite life vehicle, and after the merger did not go through with a perpetual vehicle, that's why they had to wind down the fund as a part of what was planned all along. So we do have to set the record straight on that. But the broader concern is private credit has software exposure. Private credit has grown as a massive asset class over the last 10 years.
Blue Owl was partnering with Meta for a Louisiana data center. So
there's certainly that AI, software, private credit sort of circularity that's happening. But I do want to say we recently conducted a health check on the private credit industry as a whole. And I would tell you, you look at the leverage ratios for private credit, for example, they've consistently declined for some of those private equity sponsored transactions. And in fact, leverage levels are the lowest levels since 2009. So some of those positions have been de-risked a lot. If you look at the equity cushions that you have in some of these private credit deals, they are now at 50 or 55%, which means the stock would have to go down a lot, or rather the private equity or private portfolio company would have to go down a lot in value before you sort of breach the credit cushion that you have. So, perhaps some of the concerns are stemming from AI disruption, but I would say they're certainly premature and signs of stress are not visible in private credit.
Well, the Dow is looking a little bit less stressed. It's up 69 points.
That's welcome, for sure.
We're seeing a bit of inflation, or at least inflating there. Good to see you, Anastasia.
Good to see you, Liz.
Please come back. Thanks so much.
Thank you.